Hello, ladies and gentlemen. Welcome back to the FT studios for our Global Asset Tracker series of videos. PWM is working with a panel of chief investment strategists from 35 global and regional private banks to determine the major investing and asset allocation trends. And it's our intention to share as many of these as we can with you on your screens, smartphones and tablets. Today it's my pleasure to introduce to you Wayne Bowers, Chief Investment Officer at Northern Trust, whose region of responsibility includes both Europe and Asia. Wayne, are you still telling your clients to expect positive growth from Europe?
Yes, we are, I think, but again, it's important to understand the history and the expectations that people should have from a European growth perspective. As we monitor growth themes across the world, we can see that there is a very big difference between perhaps more of an Anglo-Saxon economy, so the UK, the US, Australasia, in terms of looking at it from a kind of a peak to trough perspective. So if you could look at it from a heart rate monitor, an Anglo-Saxon economic growth period is followed by periods of boom and then bust. So you can see this dynamic happening. From a European perspective, our experience is very much kind of a shallow curve. So you don't necessarily see periods of high levels of economic growth, but you're also protected somewhat on the downside. You don't see a collapse in trade and industry. So it tends to be a very shallow growth periods that you're experiencing within Europe. And what we've seen in the last 5 years is one of economic recovery and structural reform that hasn't necessarily given Europe a significant period of long-term economic growth potential, but still that steady grind of economic growth will continue. And if you look at the makeup of growth within Europe, it's still predominantly around domestic consumption. So the export-driven side of Europe hasn't really kicked in as much as we would have expected, which is unusual based on the trade-weighted euro and the currency that's seen significant weakness. So as we look at that dynamic, would we expect perhaps more growth from an export perspective that would help Europe or less? And we would certainly want to see more growth based on the currency, which gives those exporters a lot of power in terms of being able to discount high-quality premium products around the world.
But if we look at your heart rate monitor analogy, Wayne, when we have the upcoming referendum, end of June, if the UK public votes for a Brexit, will all the doctors and nurses be hanging around the patient thinking this is a life-threatening moment, take them immediately to surgery, and will your clients be instructed to be extremely concerned at that stage?
Sure, well, it's certainly going to be a shock to the patient, as it were, and it's something that the patient probably doesn't need. Europe has gone from one crisis to another, and a lot of that crisis is based on political issues and political infrastructure. So again, the results that we see in June are going to be vitally important for Europe to be able to navigate. Either the UK is in or the UK is out. Either way, there's a lot of negotiation, a lot of discussion that Europe will have, either with itself, including the UK, or with itself without the UK. And I do think there is a recognition that, and we're seeing this from the EU even recently, that there is perhaps a concern over the meddling with member states and member nations, but also the proper functioning of Europe as an economic region as well. And there is, I think, a very central path that you can take where you don't necessarily need full harmonisation of every single policy. We can see tax being a significantly important driver of a country's economic growth. So if you're able to manage the fiscal policy appropriately, you can gain not only domestic growth but also attract inward investments. Worked very effectively for Ireland, very effectively for the UK. So it's matters like that, I think, that Europe need to understand, perhaps not just in the broader European concept, but allowing those member states to adjust and be able to flex the tools that they need to flex in order to promote economic growth, which is really for the benefit of the full Europe rather than just the individual nation.
But we're really getting to the heart now of the major risk to clients' portfolios globally is political nationalism, which undermines economic policy making, be it in Europe, be it in Asia, be it in the US with the uncertainty about the next election?
Yeah, you make a very good point. So one of the things that we've focused a lot on in recent years is really to try to understand a company's revenue versus their country of domicility. So to try and split out the company risk from a country risk. So it's a really, really important concept for investors to understand. So you may have a UK-based multinational, but 90% of its revenue may be achieved outside of the UK. 70% of its cost base may be outside of the UK. So it's really important to kind of understand that dynamic as well. So in terms of what we can see happening perhaps from a UK perspective is that if you look at some of the broad indices that closely monitor the UK market, it's doing reasonably well compared to Europe. And you could argue, well, why is that? Well, perhaps those companies perhaps have more of an export bias and are benefiting and enjoying the value drop that we've seen in sterling. So again, it gives those the earnings power that from an accounting, from a domicility perspective in pounds, greater resonance for those companies, even though the sales and cost base may be a non-sterling domicility from a currency point of view. So it's very, very important to understand and split out the country risk for the company risk.
So with this kind of picture you've painted, Wayne, what kind of asset allocation recommendations are you making to your private clients, and bearing in mind the negative interest rate environment that we're in also?
Sure. Well, we've had a bias to take modest risk within portfolio, and that risk really is in two main areas, one being US large cap equities, the other area being high yield. So we've modestly taken underweight positions in emerging market equities and developed ex-US equities in recent months. We have reduced our underweight in emerging market equities, so we're now neutral. And we do think, again, some of the headwinds that the emerging economies have seen are somewhat reducing. And that headwind really is around China, so we can come back to that later if you want. But in terms of the major asset allocation themes that we've had is one where we think risk assets will be supported by lower for longer monetary policy, for lower for longer economic growth. So you have a longevity in the business cycle, so you have a bias towards very large companies that can navigate across the world and sell products and goods and services and make money across the world. And that's been favouring our US tilt in the portfolio. And then the second aspect, again, that you need to consider is the currency aspect. And I think with the Federal Reserve potentially, again, if we go back 6 months, looking at a series of rate rises, there was a significant move upwards in terms of the dollar. That hasn't happened in terms of recently. We've seen some abatement in dollar strength and some sideways move, which actually helps stabilise and improve some of the earnings forecasts that we see for US-based companies as well. So again, that's where we're taking some of the risk within the portfolio. An offset is again, from an investment grade fixed income perspective, we're underweight and we're neutral to negative on cash. As much as you can be negative on cash, it's very difficult to run big overdrafts. But again, that you're not being paid to hold cash at the moment, and the negative interest rate policy will continue, we think, for many quarters to come.
Well, Wayne, thank you so much for sharing your thinking with us this morning, and we look forward very much to further discussions. Thank you.
Thank you very much.